world with kindness.
History there, why not? So we might as well just get down with Mr. Folletti. So go ahead and introduce yourself so everybody knows who you are, what you're about, and all that good deal.
Yeah, so basically my name is Mike. I mean, people call me different things depending on the relationship with me, right? Some people might call me, and some people know me as a DJ. Yeah, and that's how I made my name.
I was about to name drop, bro. I'll let you do it though.
But basically, my background really is, I did computer science and mathematics in college, and I've always wanted to go into finance at some point, right? So I was doing my MBA actually. 2 weeks into my MBA, I got a job with Lehman Brothers. You guys might not know, but it's an investment bank in Jersey. So I was a trading assistant actually, right? So I was more like my job was really to get coffee for the traders, get a lunch, walk on
you just soak in everything that they're doing.
Just pretty much watch them, learn some crunching numbers. But it was a very boring job, right? Because just getting to walk alone was very hard. And I was commuting from the Bronx to Jersey every morning, and then you gotta wear a beeper and customers.
Oh, you're telling your age. Beeper.
It's very a beeper, right?
You're telling your age.
So it's really tough, right? But I learned so much in that job. I did a lot of stats models. I learned some stuff. 5 months into it, I didn't like it. It was just so stressful. I moved to Atlanta, right? I drove to Atlanta with my stuff in, and I never looked back to New York City, right? So I went to work for an engineering company. I was a software developer for a hardware company. So that's kind of what I like to do, right? I like to code and do stuff, but I was still trading on the side. I had some accounts that I had from college. I bought Apple, Amazon, Yahoo, and some other Chinese companies.
Man, talking about some money.
I actually didn't look at that account for a while when I left Lehman Brothers. But I lost my job at some point in 2009. The company went under or whatever. So I said, you know what? I have some money in this account. Let me just log in and see what is in there. And I was amazed. Google shares blew up, Apple, everything. And I'm like, wow, this is amazing. Like, okay, if I can do this, what if I actually put more time into it?
Right.
And actually put more energy into it, maybe I can do better, right? So I started getting into trading. I got into options. I was learning, the fundamentals about. I know how to trade stocks, but options is a different ballgame, right? Options is more complicated, which is more what I do now. So I learned those things. I lost some money along the way because it's a rite of passage. I call it the cost of education. I lost a big amount of money. Crypto, that's not even going to crypto. I lost a lot of money there too.
I think a lot of people lost money on crypto.
Money, right?
Absolutely.
What I found is that, as you're losing money, when you lose sometimes, like when you fail, sometimes you also gain too, right? You gain maybe an experience or some knowledge, right? On how to do things better. So, that's how that's kind of how it started, where I get into more investing related ventures. And then this year when the pandemic happened, I had a lot of time on my hands, work from home. I figured, you know what? People actually ask me a lot of stock questions. Maybe I should actually start an education kind of thing. Where I could actually just, write some tips on Instagram and talk about some key concepts in investing to kind of demystify investing. Because I think a lot of people look at investing as a very, very technical thing. Maybe they watch a lot of movies and, what's that movie?
Pursuit of Happiness.
Yeah.
That big book was very intimidating. I was like, wait a minute. Until I started looking into it, I was like, oh, okay. The big book, okay, that's old school.
So, it just, I feel like the market is not really that complicated. Although it is hard, but it's not rocket science, right? It's not like some mystery black box. So that's how I started my trade. I said, well, let me actually start putting some stuff on Instagram and actually break this down into little pieces that people can understand and assimilate, right? And that's how people just say, oh, good, you're actually good at this. some of your trades are working out. I'm like, okay, maybe I'm actually good at this.
Hey.
Yeah, just started coming. You know, so that's how Mighty Trade kind of like started. A lot of my trades that I put online actually do work out. So my success rate is about 80%, and I feel like that's a high.
80% is really high.
So that's
80%.
a high good number. So, you know, people say, you know what, you should get into this, you know, do some education, whatever. I'm like, you know what, I'm going to start an education platform, Facebook, and I can have sessions one-on-one and teach people the fundamentals. Nothing too super complicated. Just the basics, how to get into investment, things like index funds, mutual funds, how your 401k works, what is an IRA, how your money can grow, you know, dividends, why those things matter, and you know, that's how everything started. So yeah, that's how Mighty Trade started. It wasn't like I intentionally wanted to do this, but you know, I just found my way into it somehow, right? And it's been working out. So yeah.
So I guess I know, and I think one of your posts, I think maybe you put a disclaimer there. So when you work with people, do you give them a disclaimer and say, hey?
Yeah, I have to say, like people always expect to make $1 million, you know, in 1 week. And I'll tell them, look, if you're not willing to lose money, you know, do not trade. I mean, maybe buy some stocks and invest long term. That's it. But trading is a different ballgame. So I always have to put a disclaimer there. Even if you're investing long term, you know, investing in the market is always risky. You know, you can lose your entire equity overnight and the company goes bankrupt, whatever. But as long as you're willing to live with that possibility, you know, investing is always a good idea. It's better than having money in a savings account. The savings account, you probably get a penny, maybe every month. That's nothing. I mean, you know. So and I feel like the way rich people get richer is, you know, they get richer by investing in the stock market. As you can see now, during this time, the gap has actually widened between the rich and the poor, right?
Yeah.
A lot of people actually made money from the pandemic. You know, you might think things are very bad, but people have made money from this, right? So, you know, this is a good time to invest. You know, Delta was down, you know, maybe about $8 at some point. American Airlines were down, MGM, all those really good companies, you know. And I was buying these companies in March. You know, I was buying this company. I was actually encouraging people. So people that bought those stocks then, MGM, Delta, American Airlines, Southwest, I mean, they're still on 100% profit right now. Even though the shares haven't gone back to where they were before, but they've made money from the lows in March when everyone was scared and selling things. That's when I was buying, you know. So I was buying the fear, and I've made money from that, right? So that's kind of how you kind of look at the market. When people are fearful, you know, I am more, you know, I'm buying. When people are greedy and buying, I'm selling. That's kind of how I look at things, and it all comes down to human emotions at some point. You know, that's so again, the market is very complicated, but again, it doesn't have to be. I think it's just people have this conception that trading and investing is complicated, but it's not. Yeah, so that's that disclaimer is always there because you can lose money, but technically in reality, you don't lose a lot of money. You don't go bankrupt in the stock market. Unless you're investing in a penny stock, that is very risky. But I'm not gonna lose my money if I put my money in Apple or Microsoft or Facebook, right? That's kind of the investment I encourage people to put their money in. Big corporations where the rich folks are putting their money in. Yeah. If those rich folks go bankrupt, if I go bankrupt, those rich folks are going bankrupt
as well.
Going bankrupt together. But what are the odds of that happening? Very, 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 very slim. Right? That's better than you going to invest in some random company that no one knows, like a penny stock. I don't like to push those kind of stocks, right? So that's not what it is about. It's about investing in big companies that are growing, and eventually you do fine too. Would you say then that you somewhat have to be a risk taker to be able to thrive, or you know? You have to have some level of risk. I mean, everyone has a different level of risk. And then all these stocks also they don't bring the same level of risk, right? Okay. If I invest in Apple, obviously it's the biggest company in the world. The odds of Apple going bankrupt or going disappearing overnight is very, very very slim, right? So maybe I want to say you need to be a very a big risk taker to invest in Apple. But generally, the whole idea is in the market you can lose money, right? Because the stock market can
accept
crash
that much,
right? So you're gonna have that at least a little bit of risk taking, to say, well, I'm fine with that, but if you don't want to lose money at all completely, you don't want to lose a penny, just put your money in the savings account and call it a day. But you're probably not gonna do well, right? Your money's probably not gonna grow, So I think everything in life comes with some level of risk. It doesn't really matter.
Absolutely.
Everything,
Absolutely.
right? So that's what I would say. You gotta have some level of risk to put your money in the market, otherwise don't do it.
Okay, so I guess what would then, because I know you'd mentioned earlier on with the trading part and and I think you threw the word options out there or something like that.
Yeah.
So yeah, this is when you start to confuse me and I'm looking at you like, huh, what? So if you could, those little elements or those, little things, could you go a little bit further before you start to show us some of your screen?
Before that, also add bonds. So,
okay.
Bonds versus stocks and then versus options. If stocks and options are not the same.
Right.
Because they're all the same.
Yeah. So everyone knows what a stock is. You put your money in a company. Company does well, you do well as well, right? You get maybe even they pay dividend, you get some of that dividend too. But sometimes companies will return money back to the shareholders. Not all companies do that, but some will do that, right? So generally, when you invest in a stock goes up. If you have, depending on how many shares you own, you make money too, and you can sell at some point. Now with an option is not, you're not buying a stock per se. You're buying a contract to buy a stock at a set price. So imagine, let's say, let me give you a very, let me break it down. Let's say I want to buy the new PlayStation 3, right? Or the new, I'm so old. Where's PlayStation now? 5 or 6? Let's say it's 6.
5 is good.
Let's say 5, right? So let's say PlayStation tells you, hey, look, you could pay us $5, and then when PlayStation comes out, you'll be able to buy PlayStation for $100. So you pay PlayStation $5 for the rights to buy the PlayStation for $100 whenever that PlayStation gets released, right? So you might be saying, well, why can't I just buy the PlayStation? Why am I paying this extra $5 for the right to buy something? Well, the reason why you do that is because when that PlayStation comes out and it's really bad, and if it's really bad, I don't have to pay $100, right? Because if I pay $100 up front and the device comes out and turns out to be really bad, I've lost $100, right? Basically, because I'm not owning a piece of device that's crap. But if I just paid $5 for the right to buy that PlayStation for $100 and it comes out and everyone is trying to get that PlayStation and the price goes up to maybe $200, because I paid $5 for that right to buy PlayStation at $100, I'm only gonna pay $100 for something that's now worth more. So you're in an option, you're paying for the right to buy something at a set price. Between a period of time, right? You're not buying it. So that way the risk is a little limited. Your risk only is what you pay in premium, that right to buy that asset for that set price, right? If it doesn't work out, let's say the PS5 came out and it was bad, I only lost $5, right? Because I'm not gonna buy it, right? But if I had bought the PS5 and it was really bad, then I'm down $100. I've lost money, right?
Yeah.
So that's kind of how options work. They give you the right to buy or sell something at a set price between an expiry time. So there's an expiry time that comes in. And another example that I can use for you, imagine a house, you're driving around a neighborhood and you see a house that you like, and you go to the owner and say, hey, I want to buy your house, but I don't have the money now. I don't have $1 million to buy your house for. And then the owner says, you know what, just give me 10 grand and you can buy my house for $1 million between now and next year, right? So you pay $10,000 for the right to buy that person's house for $1 million. Now let's say 2 months later, Oprah moves into the neighborhood. Maybe Obama moves into the neighborhood and the price of the house goes up to $2 million. I can now say, hey, look, that house is appreciated. Let me go exercise my rights to buy the house. So now I'll go to the person's house and say, look, I want to exercise my option. So I will pay that person $1 million because that's the agreement we have. And I will turn around in the open market and sell it for the open price, which is $2 million, and keep $1 million. So that's what option.
Yeah.
Option give you a leverage to make a lot of money with very, very little. But the risk again is if it doesn't work out for you in your favor, you lose that premium you pay. It's non-refundable. So if you're okay with that, then that's what we do in options. So when you see this option that I post and you're looking at 40 cents, and you see it's Apple 40 cents. What is this thing that he's posting? That is just a contract. Because when that value of the equity of the security goes up, the option itself goes up as well. The option goes up as well, right? So I don't have to exercise the option. In the example of the house, if I didn't want to buy the house for $1 million or I didn't have $1 million to buy the house, I could sell the option itself. That option that I paid 10 grand for can now be maybe worth maybe 500,000.
Okay, gotcha.
That option.
That's huge.
That's how you can flip. You can sell the contract itself, right?
Okay.
So that's pretty much what an option is about. So option gives you the rights to buy or sell something at a set price between an expiry time, right?
Okay.
So that's an option. So it's very risky. A lot of options don't work out, and so it takes a lot of research and a lot of probability analysis to figure out what are the odds that price of this security will be between this range. Right, between here and here. So you gotta use some, I don't know if you're in mathematics or in statistics, we have something called a bell curve.
Okay.
So a bell curve pretty much puts your distribution within the first standard deviation.
Exactly.
So we're trying to figure out, okay, where are we within the one standard deviation? We're trying to stay in that range, right? So that we can figure out what price should be. So that's how our options work. With bonds, on the other hand, which I don't do much of bonds, bonds are very boring, right? They're very boring. You're pretty much, the government might give out some loans, right? And then you are just paying, maybe your assets might be backed by those loans. So maybe the percentage might be like 2% or 3%, right? Based on how the bonds are structured. So long-term bonds usually have low interest rate, and in the short-term bonds might have a high interest rate, right? So if people are borrowing, if there's a lot of borrowing money in the economy, and you have some of those bonds, maybe you can make some money out of that. But to me, it's very boring. Usually, when people are close to retirement age, they usually switch from stocks to bonds because bonds are more safe, right?
Sure.
Stocks are more risky, so that's why on your 401k, if you look at it, the older you get, you see your 401k switches from more bonds and less stocks. When you're younger, it's a lot of stocks and very little bonds. Because you have more room, you have more risk that you can take in it, right? But as you're getting older, because you don't want to lose money, there will be more bonds and less stocks.
Because it's supposed to be your retirement.
Yeah, because your retirement money, you want to be investing around stocks, right? You want to have a safe asset. So that's kind of how bonds work. But me, I don't do bonds. I don't do future. I don't do bonds. I don't do what do you call it this currency exchange forex. I don't do forex either. I just stick to stocks and options, and that's it.
Okay.
These are more fun, and I like action.
Right. So yeah, knowing more about options, that was a really good nugget because there's a lot of people that have no idea what options.
No idea. Yeah. No idea.
Or they know a little bit about options, but just getting that clear overview of stocks versus options, that's huge, especially for different levels of people when it comes to risk takers because there's different people, different stages they are in life and how much risk they can take.
Exactly. Yeah.
So
if you don't like risk, I would never recommend options at all. I usually tell people, options are very risky. You never do it overnight. I mean, it does happen.
With calculated data, and having the right person on your side, someone someone who knows the ins and outs.
Yeah.
Options, it's a better option.
You can make money.
That's what I could say. Right.
Yeah. So I mean, options is what I do mostly. Although I do have some stocks that I bought a long time ago, like the safe ones, like the Apple, Facebook, whatever. But options mostly on my Instagram. It's just mostly options, and you can literally flip $100 and make 1,000, or $100 to 500. So when you get good 4 of those in a week, and you get some passive income, you make like $1,000 a week or whatever, depending on how much capital you have. Do well, but you can also lose it all too. It just depends.
Right. But I mean, at an 80% rate, using your numbers, that is that looks good to me.
So what would go into, say, someone, I guess, what would you term yourself now? Would you say you're a counselor or an advisor? Like what would be your term now? Because now there goes the disclaimer again.
Yeah, right now I would say, actually I've been approached many times to actually manage a fund, right?
Okay, so
manage a some people's money. And
okay.
I say, oh, slow down now. Like, I'm not gonna manage your account for you because one, there are tax implications, right?
Okay.
You have to pay taxes, and I'm not an accredited investor.
Okay.
There might be some legal issues, but I keep getting approached by people saying, you know what, it will just be private stuff. It won't be anything legit. It will be like a family business, you know, coming together, and you just manage it, and you make whatever trades you make the same trades for this account too. And I said, well, maybe I'll think about it at some point, but you know, when it comes to money, you know, it can get a little messy, right? When you give people's money and you want to have all that possible, right? So I usually just say, hey, look, I will tell you what to do, and if you're comfortable, go do it, but I'm not gonna do it for you.
Right.
Okay.
So yeah,
so you're just a guardian angel type of thing, right? Kind of.
Okay. So right now, I would just call myself more like a trading coach.
Coach. Okay.
Yeah. You know what? No, not like you will call yourself that. That is it. That is awesome right there. It gives a very positive vibe that you're there. I got you.
Right.
Your light just came up really bright.
Yeah. My mini makeup light.
That's awesome.
Okay, so I think maybe you can show us some things now if you want to share your screen with some of those options you were talking about.
Yeah. So before I go into options, I'd like to show you guys something called indexes, which is very safe for people to invest in. So I'm going to share my screen here.
Okay.
Let's see. Okay. All right. So I'm sharing my screen now. Typically, I tell people before you dive into options or even picking your own stocks, I usually recommend people to go into to buy an asset class or called indexes, right? So an index fund is basically it's just a bag. Think of it as a basket, right? A basket that has a little piece of different things in there. So I grew up in Nigeria, and during Christmas we had this something called a hamper basket, where they'll have cookies in there, they'll have Ribena and different whatever, right?
Oh my goodness, right? Memories.
Yeah. No, imagine if you had $500 and you wanted to invest in Amazon, and you know one Amazon share is about $3,000. Does that mean you cannot invest in Amazon? Yeah, completely no, right? No, because I can actually invest any amount in an index fund, but I can get different things, little piece of different things in that little basket, right? I mean, I might not be able to buy a full share of everything, but if I get a micro share of different things, maybe a micro share of Apple, micro share of Facebook, micro Amazon, with that $500, I can still do something, right? So when each of these companies go up, your little $500 too will also move up. So it's a very safe way of investing, or a very gentle introduction to investing for people that are very busy and don't have the time to monitor their own stocks or pick their own stocks, or maybe you don't even know what you're doing, right? You don't have no idea of what stocks you're investing. An index fund is generally a good idea. So one of the index funds, one of the ways I usually push index fund is through this website called Morningstar, right? So on Morningstar, you can literally come in and research any index fund, right? So index funds, mutual funds, what else? ETFs. You know, they're all very similar, but they have very, very, very minor differences, right? So one example of an index fund is something like a QQQ, which is an ETF. And if you were to look at it,
what do you say? What's ETF?
An ETF is more like is basically like an index, right? It's the same thing, almost like you have this big basket of a collection of stocks, right? And you get a little micro share of several stocks, as opposed to you just buying one individual stocks in isolation. With an ETF, which is basically a mutual fund, they're very minor differences. So you get a basket that has small bits of different assets, different stocks that make up this one ETF, right? So here's what it looks like. So if I go on a portfolio, I could look at I can see what is made up of. So let's look at this as a basket. So this basket, this ETF, is made up of different companies. So Apple, Microsoft, Amazon, Facebook. So you get a little piece. So if I were to invest $500 in this ETF, I'll get a little piece of each of these companies in this basket. And there are 103 companies in this basket, right? So my $500 will be divided up based on the ratio, right? So Apple has the biggest ratio in this portfolio, so it's 13%. Microsoft is 11%. So if I was investing $500, it means that 13% of my $500, I will get that much of Apple.
Okay.
Right? One whole Apple is about almost $200 or so, but 13% of $500, maybe that's about $65 or so.
Right.
I will get $65 worth of Apple, whatever that is. Maybe it's maybe it's a quarter Apple or whatever it is. I will get that much. Right? And then, so same thing applies to all these other companies. So Starbucks, you get a little bit of Starbucks, you get a little bit of TI Instruments, you get a little bit of Pepsi. So when all these companies do well, when they move up or down, you also make a return.
Your return, okay.
So the whole idea of an ETF is just to make so that if you don't have enough money to buy individual shares, or you don't have the time to actually determine what company to invest in, you just buy an ETF and let someone else figure out the basket makeup, right?
Okay.
Let someone pick the share, the stocks, and make up this little basket for you, and you just buy the basket itself.
Okay.
Right? Okay. You just buy the basket itself that has all this goodies in there, and you don't have to worry about managing it yourself. This is all managed by it's passively managed by a computer. The computer manages it for you. And you pay a little bit of something called expense ratio, which is like a quarterly fee that you pay for management, right? Someone is managing this for you, and you just pay them a little bit of maybe a cent on a dollar for them to manage it for you. So it's a very safe way to invest. It's a very gentle introduction to investing. Okay. Again, I don't have to worry about picking my own stocks. I just look at I just pick an ETF that's performing well. So how do I know that this basket is good? How do I know how it's performing? One thing about Morningstar is that it can show you the performance of the ETF. So generally, this is how we look at the performance, right? So the red line is basically the stock market itself. That's what that line represents. The blue line is your ETF, right? So generally, with an ETF or mutual fund or an index fund, your goal is to outperform or match the market. That's the goal. That's the benchmark, to match the market. You do not want to underperform. You don't want to get an ETF that is underperforming the market, because then it's no good. So how do I know that this ETF is outperforming the market? This chart here tells me that if I were to invest $10,000 10 years ago, today, if I invested in the market itself, in the stock market, that 10 grand will be worth $49,808 today, 10 years later. If I were to invest it in the ETF, which is QQQ in this instance, that 10 grand will be worth $60,000 today. So as you can see, this is outperforming the market by almost $17,000. Right. Almost, right? So this is how ETFs, index funds, this is how they're judged. They're judged by how many percentage points do you outperform the market by. Did the market beat you, or did you at least match or outperform the market? So in this instance, just by this determination, based on what the numbers, we can see that QQQ is actually a good index ETF, because the blue line is way above the red line, which is the market, right? So this is how we judge ETFs. If this blue line were to be under the red line, then it's no good. And again, sometimes these lines do intersect because past performance does not automatically indicate future performance in the stock market. Today, a stock could be good today, and tomorrow is really bad, right? But based on the history of this ETF, I was gonna say it's been consistently above the market over year, right? So I might feel comfortable investing in something like this, right? So that's how you judge ETF. You look at what's in there, what is made up of, what is the basket made up of, what kind of companies are in there, what is the expense ratio, how much am I paying in management fees every quarter. You can see that also by going to the price tab. So on the price tab, you can see I'm only paying
You better subscribe. I kid. Please subscribe. Thank you for your support.